Hello, chart watchers, and welcome to this Tuesday, July 24th Market Watchers Live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for regulars, welcome back. Well, Google reported, and we've got the reaction pretty strong, at least initially this morning. We have the Dow Jones Industrial Average currently up 207 points. The S&P 500 up 15. The Nasdaq well off its earlier high. It busted through 7,900 for the first time ever, but currently at 7,866, up 25 points. Russell 2000 lagging after testing its all-time high earlier this morning. It's down 9 points. 10-year Treasury yield up slightly today to 2.97%. Volatility continues to drift a little bit lower, was once again back below 12, where we have seen support over the past 6 weeks or so. Energy performing well today, up 1.38%. Materials also doing very well, up a little more than 1 2/3%. Technology was up earlier, has reversed. As you can see, that has led to the weakness on the Nasdaq since the open. But technology still up 0.75%. Google, huge report, blowout earnings, up $49, was up more than that earlier. Biogen also came out with very strong numbers, gapped up, but is retreating. And then on the flip side, we have Whirlpool, which missed, gapped lower, and has continued trading lower this morning. Erin, it's Tuesday, second day of the trading week. Earnings really kicking in, and the market not quite sure what to do with them.
Yeah, it's going to be exciting, as you and John Hopkins were talking about yesterday. So many reporting right now. And boy, it seems like if you miss, you're going to get hit pretty hard on your stock price because, you know, it seems like the ones that are reporting good earnings, they will do like we're seeing with Google and Biogen. But, you know, not all of them just jump that high on good earnings. But it seems like the expectation is you better have good earnings.
Yeah, and I think so far this earnings season, we're getting some pretty strong reports, but the market built in a lot of these reports. And as I posted a couple days in my blog, this is not unusual. The market tends to perform very well heading into earnings season. I think the dates that I've used to calculate that have been the 28th of one calendar month, leading up to about the 18th of the next month when earnings start. So it's once every 3 months or once a quarter. And so I always look at December 28th through January 18th, and then I go to March 28th through April 18th, and so forth, June 28th through July 18th. All of periods, when you look at them, especially the March to April period, and then the June through July period, the 3 weeks leading into earnings, the annualized returns for those 2 quarters on the S&P 500 is about 2.5 times what the S&P 500 typically does throughout the year. So anybody who believes in that theory that, buy on the rumor, sell on the news, I think that is the poster child, really, as we head into earnings season. Normally we do very well. We did it again this year. But now we're getting the news, and it seems like, especially on the Nasdaq today, after a big jump with Google's earnings, pulling back. So maybe a little bit of buy on the rumor, sell on the news taking effect now.
Yes, absolutely. It is baked in, as they say. I think you're right. We've been talking about great earnings expectations now for quite a few weeks, and there you go.
Yep.
All right, upcoming schedule this week. We have Bruce Fraser coming in. We've got Dan Russo will be in on Thursday, and while I am gone, guest co-host Mary Ellen McConigal will be with you, Tom. That should be fun. And then, of course, it should already be on your calendar, but August 10th, ChartCon starts. I'm starting to really put the fine tuning on my ChartCon presentation. All right, as far as today's agenda goes, we have Tom's workshop today, Training Earnings Gaps, followed by the 10 and 10, and OpGo Health will be our first symbol. And then I will close it out with a technical scanning workshop. So let's go ahead and get started. What other headlines and news are we hearing out there, Tom?
Well, we got a couple of economic reports out this morning. And so let's go ahead and take a look at the 10-year Treasury yield. You can see that here We are up 2.97%. We've had a really nice run, waited for a few weeks to get through that 20-day moving average. And now that we've gotten through, making a push for 3%, a break above 3%, I think will lead us up to that 3.11% high that was established in May. And that was a multi-year high going back the last few years. Couple of economic reports. We had the May FHFA house price index came in half of what was expected. It rose 0.2%. Market looking for 0.4%. And then July PMI composite flash came in a little bit below expectations, 55.9 versus 56.3. But similar to the last couple of days, it almost seems like the bond market is not really paying attention to the individual reports coming out. It seems like it's just got its mind on selling, which is driving the yields higher, as we can see right here. But a beautiful rise back up, and the PPO for the first time in the last 7 or 8 weeks has now gone back above the center line, suggesting that we are beginning to see the 10-year Treasury yield accelerate to the upside. And while you might think from a common sense standpoint that's a bad thing, it actually is. Typically, historically, it's good for equities, because as yields rise, money is coming out of Treasuries and is being many times reallocated into equities. And so that's what we've been seeing. The market's been moving higher. As I mentioned at the top of the show, the Dow up another couple hundred points today, and the 10-year Treasury yield continuing to push higher. Let's see if we can get through that 3% level. Let's pull up the Nasdaq, because we did go through the 7,900 level for the first time in history. Kind of shocking, I guess, maybe to some of those who maybe were looking at perhaps the start of a bear market back in January, February, when we had this initial drop. You can see the Nasdaq at that point at the low went down below 6,700, and here we are just 5-6 months later, hitting 7,900 for the first time in history. But it does look like we're trying to back off a little bit here. It's possible we go back down to the 20-day moving average. I wouldn't be surprised. I did mention in my blog this morning that we are shifting now from a historical bearish period to a historical bullish period on the S&P 500. But that has not really been the case for NASDAQ and Russell 2000. It's been more of a kind of a break-even kind of a period going over the next week and a half. But the S&P 500 through August 2nd does tend to perform well historically, dating back to 1950. So we'll see whether or not this latest breakout on the S&P might help us get back to that 2875 area. If we stretch this chart out a little bit further, go out a year, you can see that was the January high right around 2875. Now that we've broken out, PPO looks good. I don't really see a whole lot of resistance until we get up to that 2875 area. Perhaps maybe we struggle a little bit with a little bit of gap resistance close to 2850, but I think ultimately we're going to test that 2875 level and move through it. As far as some of the sectors and industry groups, if you go into the Pro Control Center, you can see the sector summary just by clicking on that. This will give you a quick synopsis what's going on in the various sectors. You can see utilities once again lagging. Utilities struggle when the 10-year Treasury yield rises. And if we go back 1 week, you'll see utilities really the only index getting hit hard. Consumer stocks have been under a little bit of pressure, but utilities down 1.56%. And of course, the rising Treasury yield helps financials. And check out the financials up on top, up 2% over the last week. Click on the financial sector, and it brings up all the industry groups within. And you can see banks, life insurance, investment services, asset managers a little bit lower. But these are some of the groups that tend to do pretty well with rates moving. But there are other areas that have done well as well. Mortgage finance, reinsurance, you can see both having very strong weeks. Let's take a look at some of the earnings reports that came out. Google obviously is the big one. And Google, after gapping up, and this is one of those buy on the rumor, perhaps sell on the news. We got the opening gap up, but we have been coming down since. So perhaps the open today will mark a short-term top. I don't believe it'll be a long-term top, but I wouldn't be surprised if maybe we drift back down to the 1215, 1220 area, maybe fill this gap. May not happen initially. Maybe we kind of go sideways for a bit, maybe even move to a new high. But I do think at some point we are likely to go back down to this 1220 area and revisit the breakout. Google's numbers, by the way, They came in revenues 26.24 billion. Market was only expecting 25.64. So a nice little beat there. And the bottom line, they just blew the estimates out of the water, 1175 versus 945. So great action on Google. We can take a look at a couple of others. I know when John was on here yesterday, John Hopkins, one of the stocks I thought looked really good from a relative strength perspective was Eli Lilly, LLY. And Lilly came out. They did beat their top line, 6.36 billion. The market looking for 6.09 billion. Bottom line, $1.50 versus $1.31. So a huge beat. And one of the things that, and again, I don't like to hold into earnings no matter what sets up, but as the pharmas were going down back in February through May, look at what Lilly was doing. Lilly was actually going higher and broke out recently. I said yesterday, if there was one concern, maybe it was the fact that it was breaking out on light volume. But you can see on a relative basis, money has been rotating pretty strongly into Lilly within the pharmas. And we are getting that relative breakout and an absolute breakout. And today's volume, already 3.4 billion shares. And we've still got more than half the trading day to go. So this is going to be a big volume day for Lilly. It did pull back to price support around 90 earlier. It is now back up, not too far off the high of the day. We'll see how Lilly finishes. But I think this was a solid report and a very solid technical reaction. Assuming pharmas continue to do well, I would expect Lilly to be one of the leaders going forward. Let's take a look at Biogen, BIIB. Here you can see the stock had a huge move up about two and a half weeks ago. Look at the heavy volume, 13 million shares. We tested that overhead resistance, couldn't get through. But with the biotech starting to move, one of the things John and I talked about yesterday was the biotech relative ratio relative to its peers in the biotechnology group had been performing very strongly, especially on the heels of that heavy volume move up just a couple of weeks ago. They did come out with great earnings today. Biogen on the top line, 3.36 billion. Market looking for 3.25 billion. And bottom line, 580 versus 522. So a great pair of numbers there for Biogen. We did get the gap up. We're pulling back, but this is one I would certainly keep on my radar going forward. Another stock, IQV. Let's take a look at this last one. IQV, which is IQVIA Holdings. I don't know if I'm saying that right. But this is one that certainly was anticipating some good news. The move up you can see throughout July strong. It's in that healthcare providers group, which has been extremely strong as well. And IQV topped estimates 2.57 billion in revenues. Market only looking for 2.50 billion. And bottom line, $1.29 versus $1.24. Big gap up. I mean, I think this is a great looking stock. The only thing I would say is it's going to be overbought. Maybe get a pullback if we can get the gap support, maybe around 111, 111 and a half. Maybe even that rising 20-day moving average somewhere down the road. I think that would be time. It'd be time to consider IQV. I know Erin's got a few upgrades and downgrades for you, so I'm going to let her take it away.
All right. Let's see what we do have. All right. So we did have some about, let's see, 4 upgrades, 2 downgrades. I'll try and get through these pretty quick. I want to look at the downgrades first. And I have to say, I don't see any good bottom feeding opportunities here. Here we go. First of all, when I got this chart, when I pulled it up, the very first thing I noticed was this parabolic. This is pretty much a textbook parabolic move. We're now getting the breakdown below that rising trend here. And look at the PMO. It's now turned over and is heading for a sell signal. I don't like this. Typically, when you get the breakdown from a parabolic, you're going to move all the way down to the last basing pattern. That would be way down here on the good side, an $8.75 decline, I would say. So beware of this one. It did get the downgrade, and I think that we're going to be seeing some serious problems here. I don't know, maybe a short sale if you wanted to go that direction. Illinois Toolworks, ITW, also had a downgrade today. We'd already seen a big gap down on ITW yesterday, and it's, we're getting follow through to the upside because now we're up 2.33%. But it's, really not done much damage control here after that giant gap down yesterday. And notice what we're seeing here on the PMO. We're getting a second top below the zero line. And you can see that previously these tops below the zero line lead to pretty negative movement here. So we had a top back here, and we got the decline. The PMO sell signal came in a little bit late on that move, but overall don't like this. It could be making its way back up to close that gap, but on the downgrade I would be very cautious if you're going to try and bottom feed there. 4 upgrades for you. FS Investment Corp. What I noticed is a pretty clear line here of support and the next line of overhead resistance at $8.10. We're getting really good readings on the indicators on the daily chart. And I did go ahead and take a quick peek at the weekly chart on this one, though it's not annotated, because I like this V bottom on this. We have a PMO that is now back up into positive territory. Granted, because this is a rather new stock, we don't have, mid 2015 is when we finally started getting PMO readings. So on the weekly chart, we're not seeing that much, a lot of information to go from. But, we had this declining tops trend line, and you could see the big move out of that. And now look at, we're even getting a 1743 week positive crossover. So FSIC, I think, looks pretty good right now. Mosaic also upgraded today. Really popped right out of a symmetrical triangle, heading right up toward that overhead resistance area at that June top. Notice we're just now getting a PMO buy signal. It appeared like it was going to start turning up anyway, but mostly flat on the formation of that symmetrical triangle. And now with that big gap up, we're seeing that PMO buy signal come in. You have to be aware, of course, at this overhead resistance line. But if you notice, and I can quickly annotate this for you, I want to get that auto support resistance. So right here at these two tops, you can see that the gap is come just about on, just about above that. But we're getting ready to hit this overhead resistance already. I'd wait for a little bit of a pullback here if you wanted to get involved with Mosaic. Nucor Corp also upgraded, and similar look. We have that big gap, but now we're hitting this overhead resistance. And, this is a 2.5% move to the upside. Everything's really, the table is set here, but I would beware of an island reversal here, because we are hitting some strong overhead resistance. All right, and the final one would be Square. And this one is interesting, Tom, because I know we had a downgrade on this recently, and it looks like we're going back the other direction with an upgrade. And on this upgrade, we're still seeing an over 1.5% move to the downside on Square. And I thought that was quite interesting, but we have the PMO buy signal. We know it's a strong stock relatively and in the intermediate term based on this scooter. And the OBV is still rising in a rising trend. So honestly, it popped above that overhead resistance, and it's coming back now to test the breakout space. So even though we're getting this big decline on an upgrade, I think Square's really setting up here to make the next leg up, just based on what I'm seeing with these indicators. So, even though we've got that big decline, I feel pretty good about it. And that was it for the upgrades and downgrades. Ready for your trading earnings gaps workshop, Tom? Y'all ready to get started?
I am ready to go. So let's go ahead and get this thing started. I did just want to go over a couple of things before we get going, just to kind of give you a little bit of background on some of the things that maybe you might want to consider when you're thinking about trading earnings gaps. The first one being the market maker effect, or what I call the market maker effect. When you think about it, the market makers have a responsibility to provide liquidity in the market. And when there's no news on a stock, there's typically very little volume at the beginning of the day. So even if the overall market gaps higher for whatever reason, it could be an economic report, it could be something in the news, something geopolitical, whatever. If the market is gapping up, a lot of individual stocks will gap higher, meaning that they will open higher than they closed the previous day. But a lot of times it has nothing to do with anything going on with a specific company. And I'll talk about that in a minute, but that's just considered a common gap. And I really wouldn't pay too much attention to common gaps because typically they will fill. You'll get, a $70 stock opens 20 cents higher. 10 minutes later, it's back to where it opened on very little volume. So I'm not really concerned about common gaps. Those are not really what I'm looking to trade. But the reason that it happens a lot of times is simply a market maker. You get a gap up. Folks get excited. They buy a little bit of the stock. Market makers are on the other side selling, and a stock drifts back down, and market makers are able to make their money by buying it back a little bit cheaper. But when it gets into these gaps or any kind of news where you get huge gap ups on heavy volume, the way a stock trades after that, to me, is extremely important because when everyone wants to buy a stock, the market maker role of providing that liquidity comes into play. And so if you've got everyone wanting to jump in, think about Google today. Everybody wants to buy Google because they just had blowout earnings, stock gaps up, everyone's excited, they want to buy. And who's on the other side of that trade? You don't have nearly as many people anxious to sell. So you've got market makers providing that liquidity. And in the short term, many times what you'll see is a stock start to head back in the other direction because you do have a lot of selling pressure from the market makers. And many times they will stay on the sell side of these stocks until it gets back to a support level. Now, the bigger picture for the market makers is they have to try to get the best price possible for their institutional clients. And so if you got a lot of folks out there, a lot of institutions wanting to buy Google, one of the best ways to do it is to essentially sell at the open, forcing prices back down, and those who jumped in at the top start panicking out as prices pull back. And that's when market makers are able to begin building an inventory that they can then sell to their institutional clients at a lower price. So a lot of what I do with gap trading is trying to almost get on the side of the market makers if possible. And you never know for sure what exactly that is, but there are clues. And so that's what we're going to talk about a little bit. But I wanted to just mention that first, that the market maker effect is really important. One of the stocks, actually the worst performing stock in the S&P 500, Whirlpool, actually gapped down earlier today and is continuing to sell off, which can be extremely bearish because you've got market makers who are on the other side of the trade buying, and the stock continues moving lower, even beyond market makers. Market makers really aren't able to provide any support. Look at the volume. That's a telltale sign that there is a lot of distribution taking place in Whirlpool so far today. But I wanted to pull up, let's go take a look at some charts. I've got a few annotated charts that I wanted to go over. The first one is on Shake Shack. And the next thing to consider when you're thinking about trading gaps is, is the gap a continuation of a prior trend, or has there been a change in character? Were we trending higher before and now we're gapping down and we're breaking that trend line? Because when you're gapping up or down, you're going to get the heavy volume to come along with it. And so in most cases, you're either confirming the continuation of a trend or you're confirming the reversal of one or a change in character. So here's Shake Shack. Now, Shake Shack reported back in early May, and you can see the huge gap up here. Stock was trading 47.5, gapped up to about 53 with earnings. I actually believe we had Bruce Fraser on our show right before this gap up, and he talked about this one from a Wyckoff perspective, and he said he owned it because it looked like there was accumulation taking place. So when we got the gap up here, to me, it was a continuation of a prior trend, because after going sideways, we were in a downtrend. We went sideways and consolidated for the better part of a year, maybe even a year and a half, 2 years. And then finally, we made a breakout in late 2017, one more pullback, and then back off to the races. So This gap, in my opinion, was continuation of this prior trend where we broke out above some key resistance. So that's the next step is, are we continuing a trend or are we reversing one? Because that has a big impact on whether you want to be on the long side or the short side. And in a bull market, I don't like being on the short side. I'd rather be on the long side. All right, so that's continuation. Let's take a look at another chart. Here is a change of character chart. At least to me it is. Pandora Media, ticker symbol P. Go back the last couple of years and you can see the stock was downtrending. It had been downtrending quite a bit. The overall market, remember, was doing extremely well in September through the end of the year. So if I pull up the S&P 500 here, I mean, you can see the S&P 500 rising all the way into January. You go back to Pandora and it's going the other way. Clearly, we have a downtrending stock. But look at the volume that came in back in early May with its earnings report. So when I look at this, I don't look at this as a downtrending stock anymore. Once we got the gap up on heavy volume and continued pushing higher, this is a change in character to me. No longer are we moving lower. Now it seems like pullbacks are being bought. So when we pulled back at the rising 20-day moving average, more buyers came in. And as we moved higher, look at the volume picking up again. We've been consolidating now for the past month or so, but look at the volume drying up. To me, Pandora is consolidating, probably ready for its next push to the upside. So here we've got a stock that has changed its character. Instead of looking for advances to short, now we're going to be looking for pullbacks to buy. And that's a completely different scenario than what we had seen over the previous 18 months to 2 years. Okay, let's take a look at the next thing. And so the next item to consider, as far as I'm concerned, is, and most of you I'm sure have heard that old Wall Street adage, buy on rumor, sell on news, or sell on rumor, buy on news. So what you'll see a lot of times is a stock that has been performing very well heading into its earnings report. And so you can anticipate, at least I would anticipate, that the stock's going to report pretty decent earnings. Well, a lot of times it does, and you get that initial move to the upside, and then the selling kicks in. So you've got the buy on rumor, you get the good news, and then the selling takes place. So this is Viewray. This is a small healthcare company. And you can see the stock gapped, moved lower and hit a low down close to $6 at the beginning of April. Now, they were reporting in mid-May, and over the course of the next 6 weeks, especially over these 3 weeks here, the stock ran up 40% in about 3 weeks, pulled back and was starting to turn higher again, came out with earnings that beat Wall Street estimates. It's a small company, $26 million in revenue. Market only looking for $15.5 million, though, so a huge beat. Bottom line, yeah, they've got a loss, but the market was looking for a 22-cent loss, and they cut it in half. They only lost 11 cents. So we got this huge reaction. The stock was at $7.70, opened at $8.50. So it was up 10% at the open. And then look at this huge red candlestick on very heavy volume. Now, that would probably scare a lot of folks away. And a lot of people would just say, well, market doesn't like the report. I'm not interested. But I actually put it on my watch list, and I traded this one successfully twice when it pulled back. And in fact, I think I've got this one later in my presentation. I do. So I'll save the trading strategies for a little bit later. But the key here is that after it reported earnings and gapped up, you can see it pulled back to about 670, 680 here and established support. And then after bouncing back to $8, and actually I think it was the second time when it came down here, right here at about 680 or 690. I remember buying it. I think it was low 690s. I ended up taking profits. I might have taken profits pretty quickly, maybe at 720 at this prior high. I think I did, as it was getting up around the 20-day moving average. Anyway, it went up to 8, and it pulled back one more time. And I remember actually talking to Greg Schnell the day that this one reversed. It had gone down below the prior support level and then came back up. And you can see the move now, what has happened since then. I think all of this right here was accumulation by market makers. You can see the volume picking up here during these moves to the upside. The pullback here and reversal, it looked like we should have been breaking down, and instead we closed at the high of the day, and that launched the stock higher. Now, I actually bought on that day, and I'll talk about this again a little bit later when we go through some of the trading strategies. But the key here that I wanted to stress is that a lot of times the market will build in good news before a report comes out. And so sometimes you get these candles that don't look very bullish, but they can set up some great bullish trades and setups as we go forward. Next one, sell on the rumor, buy on the news. So this is just the flip side. Look at Whirlpool. Back in late January, we were at a high, double top. And for about 2.5 months, almost 3 months, we went straight down from $185, hitting a low in the mid 140s. Now, of course, the market was getting hit, but the market wasn't breaking down the new lows. We were seeing relative weakness in Whirlpool. And when they came out, they missed their revenues and they missed their earnings per share. These were the numbers. $4.91 billion in revenue versus $5 billion expected. $2.81 on earnings versus $2.92 expected. So they fell short top line, fell short bottom line, but they gapped up with the bad news. So here the market's been selling off, anticipating the bad news, selling on the rumor, and then you see the market actually being bought on the news. Comes back, fills gap support, takes one more move to the upside, and then right back down it goes. Whirlpool reported this morning, and they missed by a wide margin. Worst performing stock in the S&P 500. So after a downtrend, got a little bit of strength, sideways consolidation, and now this is a continuation gap to the downside. Okay, let's take a look at some types of gaps. All right, there are four different types of gaps that I view. One is the common gap. We talked about this earlier, and so I just wanted to point out a couple of these. First of all, here are 2 days where we've got very average volume, nothing big, no news was out, and yet Steel Dynamics had closed at about 49.50, if you come across here, 49.50 on June 4th. The next day, June 5th, it opens at 49.35, 49.40. So we dropped 15, 20 cents, something like that, at the open. And by who knows when, sometime that day, clearly we were right back up to the prior day's close. So we filled that gap. We gapped lower, traded down intraday, came back up, filled the gap, and did it on light volume, average volume at best. A few days later, you can see we'd actually closed at $50.50, and then we opened higher. And I don't remember the news, June 11th. Who knows what the reason was why Steel Dynamics gapped up. It could have been steel stocks were just in favor that day. Maybe there was something out there with the tariffs. I don't know. But the stock gapped up. You see, again, volume was very light, average at best. And after trading up intraday, we came back down, filled the gap. Very, very normal for a stock to have just a common gap up or gap down and fill back to the prior day's close all in the same day. These are just common gaps. They happen all the time. I'm not interested in trading them. There are some that probably do. You probably get a lot of these light volume gaps in one direction or the other, and you have a lot of very, very short term, maybe day traders looking for that gap fill, and they get out. That's not my shtick, but there are probably many out there who do trade these common gaps, just not really anything I'm interested in. But again, you're going to see these all over the chart. I mean, I could probably point out a ton of them. Here was one where we had closed below 46.50 the next day, and this was on pretty good volume. We had a gap up to about 46, I don't know, 75. We ran higher, and look what happened the next day. We were right back down to where we were the day before. So again, just common gap. Nothing, wasn't earnings related, nothing big on that particular day. All right, let's keep moving on. Take a look at a couple more of these charts. WMGI, and this is my setup from this week, and it's struggling. I might be stopped out of it today, but we'll talk about that in a little while. But I wanted to mention a couple of different gaps that occurred on this chart. Here we have a downtrend, and a breakaway gap to me is kind of a change in character kind of a gap, where we're downtrending, all of a sudden heavy volume, 4 million shares, among the heaviest volume we'd seen over the past couple of years, and we gapped up from $20 or a little below $21 up to about 23.5. It's a pretty good move, up more than 10%, very heavy volume. And notice after the gap, we continue pushing higher. And if you notice, a few weeks after the breakaway gap here, we had a continuation gap. So now we're starting to uptrend. Volume again comes in June, and we gap up. That is a continuation gap. Breakaway gap changes the character. Continuation gap continues the trend. Now we are back down today, and we'll see where we close. But that gap support, I'm pretty sure, is $24.68. And then if that fails, you've got the gap support probably closer to about 23.5. Now, on this particular chart on Hasbro, I've got all kinds of different gaps over the last couple of years. Here's a breakaway gap. We had been trading sideways, change of character, big gap up. Notice when we came back down here, we came back to the top of the gap support and then had a continuation gap back to the upside, printing a new high and then continuing to go higher. We also had a trend line that was established going about 6-7 months into year 2017. But with earnings, look at the gap down and change of character. This is a breakaway gap right here and a change of character from the uptrend that we had seen. And it was done on very heavy volume to the downside. Coming all the way down to the bottom here in April, this was earnings related. Stock had been under pressure. It gapped down, massive volume. And this is normally the case with an exhaustion gap. Everybody just throws in the kitchen sink, can't take it anymore. Hasbro was at $102.50 in February. And 2 months later, it was down in the 70s. And finally, on that gap down with the earnings report, everybody said, I'm selling, I'm getting out. Who's on the other side of the trade? Market makers. Market makers benefit when the stock price recovers. And look at that recovery from 78 bucks, 78.5 up to about 86 that day. A bullish engulfing candle. That was the end of the selling. We start moving higher, pull back at the 20-day, and now we got the continuation of this trend to the upside. That was with earnings yesterday. So Hasbro looking pretty good. All right, let's talk about trading strategies a little bit here. So let's go back to Viewray. This is one that I mentioned earlier. Here was that earnings gap where it had kind of been anticipated. We got the pullback. And one other thing that really shouldn't be lost here is Viewray is a small cap healthcare company. And small cap healthcare stocks, I'm going to pull up PSCH, which is a ETF. It's the Invesco S&P Small Cap Healthcare ETF. Take a look at what this stock had been doing. And I'll go back a year. Because all of this really has to be considered when you're thinking about trading. I mean, you want to be in areas where the stock market's doing well, those areas of the market. So the PSCH, you can see, continue to move higher. Here's that January high. The market, the S&P 500 still has not cleared the January high. Look at PSCH. Small cap healthcare has been wildly outperforming the S&P 500. So when you're thinking about trading, wouldn't be a bad idea to consider small cap healthcare stocks, especially ones that pull back and start to establish pretty clear area of support. Another way to look at this would be to simply pull the PSCH up versus the S&P 500. And what you'll see is on a relative basis, the group has been performing very well. And if we pull it up relative to the XLV, so this is small cap healthcare versus the XLV, which is going to have a lot more of the larger cap healthcare stocks. And again, you see small caps wildly outperforming the large cap. So now let's go back, take a look at that Viewray chart again. So now we've reported great earnings. That was on the other chart. Remember, that was a loss of 11 cents versus 22 cents. And revenue 26 million versus 15 million. Had great numbers, but it was already anticipated. We got that gap up, and many of these small companies can really be manipulated by market makers. First of all, there aren't a lot of market makers on small companies because there's no money to be made. So you get a lot of market makers on stocks like Intel and Apple, where you've got millions and millions and millions of shares being traded every day. But when you get into smaller stocks that are $7, $8 stocks, and many days trading only 500,000 or 500,000 shares, think about the dollar volume going into a stock like this versus Apple, which is much higher dollar price stock, also trades in the many, many millions of shares every day. Viewray is just not a profit center for market makers. So you get very few market makers to make a market in Viewray. And so you can get some pretty wild moves, but you can take advantage of it as well. So here, Viewray trades up, comes back down, establishes support. A lot of times I'll wait for a period of time after earnings and let them establish a trading range on a daily chart before I start getting involved. Here, we came down, we set a bottom, we bounced back up again, probably close to 10%, 8%, something like that. Pulled back. I'm almost positive I bought on this pullback around 690. And then as it came back up, I remember taking profits pretty quickly. Might have been right here at the end of May, early June, because I do recall taking about a 5% gain on this one and then watched it go higher. And I thought, okay, here it goes to the moon. But it came back down one more time. It wasn't this day that I bought. I'm pretty sure it was this day. We had an intraday low that took out this prior low. So it should have triggered stops and continued to move lower. But instead, we got a big reversal and we came back up. And as that came back through price support, leaving that tail down below, that to me is where it was a great buy from a reward to risk standpoint. Because if it goes back down, you can set your stop so that if it takes out the intraday low, you simply move to the sidelines. But in this case, we've continued moving higher. I actually got out of this one. I'm kicking myself now, but I did get out at 790. But if you think about it, you get in at 680 and you sell at 790 one day later. It's kind of hard to be too upset about that. So it's continued moving higher, great volume. Now we're seeing the accumulation of traders and so forth. Now the stock's making a breakout or has made a breakout. But Viewray, I thought, was a great trade. Now let me show you one that didn't work out so well. CYH, Community Health. Here was the earnings report. Huge gap up. To me, it looked like change of character, breakaway gap. So when it came back down, I actually bought here, right, almost right on support. I want to say that open was 429. It was either 429 or 431. 431. Okay, so 431, it comes back down here and hits just below 431, closes at 436. I thought that was it. That's where I figured we were going to go higher. We were sitting on the 20-day moving average right at gap support. Thought it was a perfect trade. It went up. I didn't take any profits. It came back down, and on this particular candle, I actually got stopped out on the way down because it took out this prior intraday low. But then it came back up and closed, holding on to support at that 431 level, and I ended up buying back in that day. Looked great again the next day, and then 2 days later, got stopped out for the second time when it took out the intraday low again. So this particular trade didn't work, and this is also a good reason to keep a stop in play because you can see the stock went down to 270. If you're just holding, waiting for it to get up here to $5, this would be very painful. So I think it's important to keep your stops in play. If you see something that's setting up visually for you on the chart, you like it, you feel like you got a great reward to risk, don't be afraid to take that small loss and move back to the sidelines. Polo Ralph Lauren. Now, this is what I was watching, and actually this was a setup, Monday setup a few weeks ago when it came down here to this 125 and change level. And that's where I got in. I got in just above the 50-day moving average. It didn't quite get down to this 122 level. That would have been a second entry for sure at gap support. Look at the volume on this gap up. Remember, when you gap up and you keep going higher on heavy volume like this, that is a sign of really significant demand. And so when finally the stock starts to sell off and gets back close to some key support levels, I think it's an awesome trade, reward to risk trade. So here it went up. I actually, again, was a little bit nervous as we moved toward the middle part of July because of historically being one of the worst weeks that we actually end today. So as it made a move, I think I was only up like 2.5%, but I went ahead and took profits on the trade, thinking I might get another pullback to 124 and change, maybe even 122. And it didn't happen, kept going higher. But again, a profit's profit, not going to complain. Sorrell, S-O-R-L, auto parts company. Here's your move up, earnings gap, gapped higher, went all the way back down, established a support level, very similar to Viewray, bounced, and look at the hammer that hits right on price support. 4 days later, the stock had moved from $4.45 up above $5. That's more than a 10% move in a week. Now, I'm not saying that. I didn't trade this one. It was on my watch list. I saw it. I thought it was a great setup after the fact. I didn't see it when it printed this hammer, or I probably would have owned it. You can see the tail here actually took out that prior low. So again, it should have been a breakdown, but it reversed, held on to support, and literally within a week could have been over a 10% winner. CTRP, this one gaps up, very heavy volume, continues moving higher, pulls back to the top of gap support. You can keep a very tight stop, maybe the 20-day moving average. 2 targets on this one. One would have been 46.5. The other would have been to challenge the March high, close to 50. This was, again, one I did not own. This I just wanted to just point out the gap support, the top of gap support. When you get the heavy volume, you keep moving higher. A lot of times that will establish your key support at the top of the gap instead of the bottom of the gap. And sure enough, we did make a big run off of it. But look what C-Trip has done over the past 6 weeks. It's been going straight down. Hard to say how the next report will come out. But this is why I think it's more important to trade than to buy and hold, because there aren't too many Netflixes out there. I mean, Netflix has been a great company, Amazon, Apple. I mean, certainly you have a ton of these companies that have been great long-term performers. But many of these companies come out with great earnings, are awesome for one quarter, and they're horrible the next. And so buying and holding them a lot of times is not a good strategy. So if you're lucky enough to get into the really good ones, that's awesome. But many of these stocks do not continue moving in the direction. So they're more short-term trades. All right, and that is what I had for this presentation. So let's go ahead and pull up the summary slide, and we can talk a little bit about what we went over. First, we have the items to consider. For me, number one, market maker is the big one. That's why I short-term trade. I'm trying to get myself on the side of the market maker. I remember back in 2010, the first quarter, and this was after we had that huge decline, the bear market, 2007 to 2009. And I remember Lloyd Blankfein coming on the Charlie Rose show after the first quarter of 2010. And he was essentially bragging about his market-making unit and how much money they had made in the first quarter of 2010. And I'm thinking, you know, there are a lot of individual traders that got crushed by that bear market, still don't have the nerve to get back into this market. And you've got one of these guys at Goldman Sachs bragging about how much money they're making, and how it wasn't that long before that they had done the, the mortgage products, the subprime. And so it was just more than I could take. But if you get the market makers on your side, many times that will help you in a short-term trading situation. And you never know exactly what they're doing, but the candles, the gap support, the reversals, price support, all of that builds in and can help you trade alongside the market makers. Look for the continuation of trends, or the change in character, the various types of gaps we went over, talked about, and there's some of the trading strategies that you can consider. So that's what I had for the Trading Earnings Gaps workshop for today. I know at the beginning of the show, we did a poll. Hopefully you've had a chance to fill that out. It's amazing to me. I always wondered, would we ever have a $1 trillion market cap company? And earlier today, Apple, with a market cap of $949 billion, if they come out with a strong earnings report, I think they report next week, they could be looking at $1 trillion with that, with a gap up on earnings. It would take, what, about 6 or 7% move to the upside, something like that, maybe 6. So we'll see. But 81% of you are going with the second highest market cap company. I don't blame you. Amazon, $889 billion. Then you've got Google, $863, and Microsoft, $830. Microsoft, the software group's been on fire. I don't know. What do you think, Erin?
I went with Amazon, and, somebody mentioned in the chat room, like, well, what if you don't think Apple is going to be the first one? I have to say, I mean, granted they report and all of that, but I'm with that guy. I think you could almost make a case that Amazon will get there before Apple. So I definitely like Amazon for sure.
Yeah, the poll was written so that Apple is in line to become the first, not that they will become the first. But yeah, I completely understand what you're saying. And I think Amazon could be the first. They've got their earnings report coming up, and it wouldn't be a shocker to see them up 10% with earnings, and that would put them awfully close. So got a number of stocks, though. I mean, would you have thought 10 years ago that we'd be having this discussion?
Absolutely not. Absolutely not. It's crazy. It's crazy.
Yeah, they've been on fire. They've been on fire, all 4 of them.
Right. And honestly, I mean, barring something catastrophic, I don't see any reason why they won't just continue going up. I mean, they're strong stocks. They pay a good dividend. They're the kind of stocks you want to be in, having that portfolio. So,
I get it.
All righty. Well, I think it's time to do the 10 and 10. We want to give you plenty of time. So I'm going to get that ready for us right here. Okay, so I did the daily RRG. There were about 30 requests. So, a third of you are going to be very happy because yours will be picked. So I was just looking through, and one of the things that Julius was showing us is that you can click through. And I went to the weakening category, and I'm going to click through if I can get to where it was here. All right, there we go. If you hold the shift key down and then arrow, you'll be able to go through like that. So anyway, I thought it was interesting. You can see most of those weakening aren't going in the right direction. So what we look for are those northeast movers. So we'll have to see where we get with that. I'm going to go ahead and hand it back to you. Our first one is going to be Opco Health. This was requested yesterday and we didn't get to it. That's how I usually pick our first one. So if you didn't get selected today, there is a chance you'll be the first one tomorrow. So,
all right, let's do it. OPK, Opco Health. I think it looks really good. First of all, this is a biotech stock. Biotechs really have caught fire in July, and you can see Opco, after struggling at about $5 for the last couple of months, actually broke out. And when it broke out, look at the volume expand to the upside. That is a sign of accumulation. I like it. To the downside, you've got the rising 20-day moving average that's been holding. We're getting close to it. I think that would be one key area of support. The other is simply price support, where we broke out from at 5. It is a volatile stock. I mean, we're talking about a company that was trading at $3 back in May, just went over $6, $6.25. So that's about a 70% move in about 2 months. So when you're talking about, potentially buying at $5.50 and $5, you say, well, wow, that second entry is 10% below the first entry. But again, keep in mind, this is a stock that's moved more than 70% in a little more than 2 months. So we've got to kind of keep that in mind. The other thing I'll also point out here, and many of you probably don't realize this, but seasonality. We've talked about how biotechs do really well in the month of July. And that is the case with OPK as well. 3.1% average return over the last 20 years. But look at August. It goes up 63% of the time, 63% of the Augusts. So roughly 2 out of every 3 Augusts, we've gone higher on OPK. And the average return over the last 20 years, 10.7% during the month. So many of the biotechs I know have produced very strong results in July, but OPK is one of them that I'm sure posts very strong results for the month of August as well. So just wanted to point that out. I think in addition to the stock looking good technically, pullbacks into this area could set up beautifully given the seasonal performance of OPK.
All right, let's see. What is the most popular in the chat room? It looks like, oh my goodness, there is a tie. So we'll probably look at both. Etsy, I know that's one that, has been in favor for a while. I got out and after making a pretty tidy profit, but did not get to take advantage of all of that rising trend that happened after. So kicking myself a little bit, but it was a short-term trade and I planned it that way. So
yep, this has been in a pretty nice trading range after gapping up with earnings. I remember earlier when we had talked about this, was probably back in April, May timeframe. We had higher prices, lower PPO, negative divergence. So I look for a 50-day test. I look for a center line test. We got both of those, and now the stock has gone back up again. Now, the PPO is definitely on the decline, but we don't have a negative divergence really in place. We have equal highs for the most part. So I think it's just consolidating. I think 40 to 41 is great entry into ETSY if you like the stock. And I would be looking for another run for 45.
Okay. The next one I got for you is Shake Shack, SHAK.
All right. Well, this is one I just looked at in my workshop.
Oh, well, there you go. We can change it.
That's all right. The short term, I think there are a couple things I can talk about that I didn't touch on. First of all, there was your resistance at 70. Notice 2 days ago, we broke above 70 on an intraday basis and then closed on the low. That's usually a short-term warning sign. I think you've got this stock trading between about 62 to the downside, 70 to the upside. The pullback has been on pretty light volume. Closer it gets to 62, the better I like it on long side.
Okay. The next one, let's try Zion's Bank Corp, Z-I-O-N.
All right, bank's definitely doing much better. This one is struggling though. And so that bothers me a little bit to see the banks really starting to take off and this stock trading near a multi-month low here around 51.5. I would just say to watch very closely. If I'm in this one, I want to watch closely that February low. We haven't had an open or a close below 50. The high was 58.5. So we are at the bottom end of the range, but volume is heavy. I'm not sure if they reported earnings today, but volume is very strong today with a big gap down. So I'm guessing that they did report maybe this morning. But I would be watching maybe that 50.5 area. If you like the stock looking for entry, I would maybe consider that. But if it breaks down, closes, say, below 49.5, that would be my kind of my indicator or signal to get the heck out.
Okay. This was very popular as well. Medtronic, MDT.
All right. MDT looks really strong to me. We've got recent highs about 87.5 right there. We had broken out, and I think on a long term, I probably should have pulled this up on a weekly chart because I want to say maybe that might have been like a long-term chart, long-term resistance somewhere in here because I thought that was a breakout on the weekly chart in early June. But anyway, we had pulled back one more time at the 50-day. We had higher prices, lower PPO. There's your 50-day test. Here's your PPO center line, almost test. And now the stock's moving higher, PPO strengthening again. I like it. I think the rising 20-day moving average is your best entry.
All right. How about the Mexico ETF, EWW?
All right, I'm going to take this one out weekly and just take a look. Yeah, I'm not, I mean, it's been strengthening here in the last 6-7 weeks. So I think that's awesome. But, oh, I want to go out further than that. Let's go back. Let's do 5 years. The problem is you can see back in 2014, we were up 67, almost $68. Now we're at 51 and change. The overall character of this chart still remains down to me. It looked like we were maybe changing it here back in the middle of 2017, taking out these highs, but we've since put in some pretty low lows. I'm just not a fan. If I was looking for some strength somewhere, I'd continue looking here in the U.S. where the market has been much stronger, especially on the Nasdaq and even with some of the small cap stocks. So to annotate it, I mean, I'd probably be looking at some key resistance levels. You got a double top up there at 54 you've got to watch for. Above that, you can see 56.5 was a big problem. So these are going to be two major areas of resistance as we go forward. To the downside, I don't want to hold it all the way to 44. So if you're treating this as though this is going to be an uptrend or the start of an uptrend, then I'd watch that rising 20-week moving average to the upside, or to the downside, I should say. That is just below $49.
All right. The next one was very requested. This was the second most requested. Union Pacific, UNP.
Okay, Union Pacific. I don't like today's candle so far, but it is on light volume. We got close to the resistance up here at 148 and then came back down. So clearly we've got a break above 148. That is your short-term resistance area. I think pretty clearly support. You can see all these tops coming across at about 138. Here's a pullback to 138. Here's a pullback to 138 and change. We gapped a little below 138, then came back up with a hollow candle. So let's put a second support level right there on that candle body. I'm going to say 137.5 up to about 138.25. Key support, 148 is resistance. If I was in the stock or trading the stock, I would trade that range.
Okay, and actually that one was pretty funny because in the request it says good second quarter results reported July 19th. Could this choo-choo be leaving the roundhouse and heading out on the main line? Sounds just like a Greg Schnell, the beginning of one of his articles, doesn't it?
Sounds something like that for sure. I don't know if the choo-choo is going anywhere until it breaks above 148.
There you go. AT&T will be our next one, the only utility that was requested.
Yeah, I've said before, I'm just not a fan here. Let's look at the relative chart. on AT&T. I mean, it just continues to downtrend. The group itself continues to downtrend. I'm not sure. Well, T is probably the major component in the overall index, and that's probably why you're seeing these lines stay the same for so long. But this one, you know, you see the support area, 31, 31.5, I think is the major area. So I'll annotate, show you that support. So that was that earlier support there, just above 31. Here was the lowest close, just below 31. This is an area needs to hold. We're bouncing off of it so far. Look at this downtrend. I mean, there's so many great looking charts out there. I'm trying to ride momentum to the upside. I'm going to pass on AT&T, or continue to pass on AT&T.
All right, there you go. How about ABV? ABBV.
Say that. Oh, ABBV.
ABV.
Yeah. Okay, so we got another biotech. The problem is this one has not been, I mean, we're on a relative basis. We're now at the 2018 low. So that is probably the biggest problem I have with this stock. I like the sector. I think we're starting to see some strength. We're still in the summer period, which tends to be pretty strong for biotechs. But over the last 2 months, it has been going straight down relative to its peers. So I just see so many better stocks. The gap down on heavy volume. Look at the selling here on big volume. We just gapped down again, moved lower on heavy volume. I would really seriously be careful if the stock breaks below about $87. I think that is major support going back over the last year or so. We're bouncing in the near term off of it, but look at the light volume. This is not performing well when you consider what the biotechs overall have been doing. I would pass on it.
Okay. And our final one is from the auto parts industry, Magna International, MGA.
Okay. Well, it's shown some relative strength. It definitely showed relative strength, as you can see, for about 3 or 4 months earlier this year. It's been pulling back both on an absolute basis and on a relative basis. So I think what I would do here is I would be watching the relative strength. So check and see if we can break out of this downtrend. I want to start outperforming the peers. So that would be one thing to watch. And then from a price support standpoint, that recent low off of this downtrend, you can see that reversing candle, and then we bounce to the 20-day. I actually want to get back up above the most recent high. I think this is the range we're in. If we can break back up through 62 and you see relative strength kick in again, that's when I would consider MGA. Until then, I think we're just in this range, fairly narrow range from, let's call it $57 up to about 62.
All right, that is it. That completes the 10 and 10. And here are the symbols that we looked over. I will be getting those up into the Market Watchers Live chart list, so you can access all of those with the annotations. Just go to the blogs tab, and then you'll find the Market Watchers Live blog, and right there at the top will be the link to that chart list, as well as in every one of those blog entries of recaps. All right, we will be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, it's time for our final market update of the Market Watchers Live show. Interesting bifurcation, I would say, of the markets right now. We do see the Dow and the S&P 500 were up on the open, and the Dow's still trending higher. S&P 500 consolidating, but look at what we're seeing in the tech space. Nasdaq 100, we gapped up, but we've pulled way back. The Nasdaq itself is now in negative territory, and check out mid caps and the Russell 2000. While they opened on the upside, they didn't spend much time there on the upside and have been traveling lower and lower and continue to make new intraday lows right now. TSX gapped up on the open, but has also pulled back. It's getting ready to close that gap. The Treasury yields are down slightly, reading at 2.96%. UUP, we can see, is up, but only by 1 cent, currently reading at $25. GLD, also mostly unchanged, but up 3 cents to 116.03. USO forming a nice intraday flag here. We had a big move on the open, and now we're seeing some consolidation and the formation of a pennant on the end of the possible flagpole on the intraday chart. Volatility index is lower on the day. We actually got all the way down to a reading just below 12, but currently reading at 1241. I'm going to show you our predefined alerts. This is like our headline news right there on the member dashboard for you. And I wanted to point out, of course, the Nasdaq did set a new all-time high earlier this morning, but clearly not having that luck right now as it's pulled way back and is in negative territory. This one just came in, though, the materials sector. The BPI has just crossed above 50. So let's just take a quick look at XLB. And here you go. It's been really consolidating for quite some time, sitting right on top of that 200-day EMA. You can see a very flat PMO, nothing really happening here. So even though we got that message on the member dashboard, as far as the BPI crossing above 50, I don't see anything that exciting on that chart. You can see most active right now, top 10 in the S&P 500. The big mover is AVY. And you can see on that hovering over that symbol, we've got a huge move to the upside on Avery Dennison, the biggest mover right now in the S&P 500. Scooters, large cap top is also Avery Dennison. Not a surprise because we are seeing such a big move to the upside. And that completes our final market update. And Tom, did you want to add something?
Yeah, I want to take a look again at the small caps because I think this continues to be something that we need to watch closely in the second half of 2018. Russell 2000 has underperformed the S&P 500 here recently, and part of the problem is we're at a technical crossroad where we keep coming up against this resistance. This is an all-time high. Earlier today, we got to 1706 and change. That literally is the all-time high close on the Russell 2000. So once we got there, just like we saw a couple of weeks ago, sellers kicked back in. Russell 2000 underperforming on a relative basis. We topped back a little over a month ago. We have been underperforming the S&P 500. I believe that will change, and the reason I believe it'll change is the relative yields of the U.S. versus Germany that I've shown many times before. Here you can see we are starting to turn higher again. And with that, I would expect eventually we're going to get this dollar breakout, the dollar index above 95. And when that happens, normally what we get is that relative strength back to the upside. So, and I'm talking about the Russell 2000 versus the S&P anytime that dollar rises. So the two things I would be watching, number one is, can we get the dollar index back through 95? If we can do that and this correlation stays positive, I would look for the Russell 2000 on a relative basis to turn back up. We now have a double top, by the way, just above 0.61. That's the ratio. If you take the Russell 2000 index divided by the S&P 500, if we can break above that level with the dollar also breaking above 95, I think that sets us up for a strong second half of the year for small caps.
All right, excellent. Well, I'm going to go ahead and get started on our final segment on technical scanning. I love doing these segments. There's so much to learn about scanning, and I want even the beginners to feel comfortable enough to go in and dig around and try some scans. And so let's go ahead. I'm going to share my screen here so that we can look. I'm going to start with the member dashboard. And I'm starting here because you can add right here a scans and alerts button. Okay, so by having that checked, you do have the scans right here and the alerts section, which you won't see is if you have that box unchecked. So what I wanted to concentrate on was using predefined scans. And I think this is a great way for a beginner to start. And so let's go ahead and if you click on the predefined scans, it brings up all of the scans that StockCharts just runs every day, all of the time. And so it's a great place to go and maybe find some interesting stocks for buying, shorting, because not only do you have the bullish technical indicator scans, but you also have the bearish technical indicator scans. I think these are great and they're very useful, but let's take, for example, let's do the new 52-week highs. There right now are 326 stock symbols coming up. And that's way too many for me, at least, to start weeding through to find the best, your best opportunity. So how do we, close this down a little bit? How do we focus this in? And the way we can do that is by editing the scan. And it's right here up in the corner. So once you click, let's go back just so you can see. So once you're on that predefined scans page and you click on looking at all of the stock symbols, it'll bring this up. Click here to edit this scan. And this is the easiest way to start narrowing down what you want to look at. And so let's go ahead and right now you can see it's all we get is the type, it's stock, and we know that the daily volume is set up in this way. So I think that, obviously we need to narrow this down. One of the problems I have with the predefined scan results is that it adds a lot of, the London symbols, and no offense, Canada, we have the Canadian ones in there as well. And a lot of us don't trade those. So I want to, first of all, let's just go ahead and narrow down the country. And I just add that, and it defaults to the country being US. All right, so let's just see what happens when we run the scan now. Now we have 275. Well, that helps somewhat, but I think we need to set this up a little bit better here. So let's see, I'm going to close this tab and come back. All right, so one of the things you might want to do is, okay, I don't want to look at, small volume stocks. I want to look at something that's got a bit more volume to it. So I'm going to go to my technical indicators, and I'm going to click on, let's see, where did I find it? Actually, I think I did right here in volume. Volume. And I'm going to add that. And so this is, it comes up, of course, where volume is immediately really way higher than I want to see something a little less than that. I want to have, but I want greater than, let's say, greater than 700,099. All right, what's happening now when we run the scan? We're down to 58. Okay, I'm going to add one more thing in there to try and get this down even more manageable. And I think I will add scooter. So we'll go to technical indicators, and we're going to go to the scooter. I know it's in here somewhere.
You actually can get that over on the right-hand side, Erin, price, volume, and scooters.
Oh, there we go. Yes, scooters. That's right. It's already in there. All right. And we added that right there. Okay, I'm not going to go with above 90. Let's do my little hot zone that I like, that Greg Schnell taught me about. We want greater than 75. So now let's run the scan, and what do we get? All right, we're down to 50. That's still a little more than I want to look at. So I'm going to go back one more time, and let's see what else we can add in here. I'm going to add my PMO in here. So let's go to technical indicators and PMO signal line. I'm going to add that, and I'm going to add the PMO line itself, the values. All right. And what I want to do is I want something that's had a positive crossover. So actually, let's see. I'm going to go steel, actually. And this is something you can do as well. So let's go back up here. I'm going to give us another tab. I want to steal from one of my other scans. So I'm just going to save a little time for us all. And I'm going to edit that so I can grab what I want. So I'm going to use the PMO rising for the last 3 days. So I'm going to use that as what I'm going to include on that other scan. So let's go back here. Paste that in, and now let's see what we get. This should cut it way down. 27. I can deal with that. So now I need to, before I can manipulate it or do anything at this point, I have to replace a chart list or merge it. But I'm going to replace one, and I think many of you have seen it. Again, another great idea I got from Greg to create what's called a scan dump, somewhere where you just dump your scans and then you can decide what you want to do with them, move things to chart lists and that sort of thing. So these were the ones, and interestingly, I'm recognizing a few of these symbols that we've looked at recently. All right, so the best way I think you can do this, and the best way to sift through a scan, is using the candle glance function. And it is important to set up your candle glance to look like you want it to look, so that you can really get the information you need right away. And so this is a candle glance that I had set up earlier. And what I'm looking for is what's going on with that PMO. I'm wanting to look and see if there are any interesting chart patterns, any interesting breakouts, because remember, this started off as new 52-week highs. So all of these we already know are moving in the right direction. And so I'm just going to peek through here and look at anything that looks interesting to me. This one, CSX, looks interesting in that this gap right here came down and got tested again, but we're holding that support level. So let's just look at CSX a little closer. There we go. All right, so we have that support level, but then there's that gap right there, and that's gap support, and we held it. It went down today and it tested that area, and now it has moved back up above this level of support, but it hasn't, it's still a bit lower in that range, and in fact is down over 1.33%, but still has excellent looking PMO. It has an excellent OBV. It's in the hot zone. All of these things are lining up nicely for a continued move to the upside. And again, like to see those pullbacks. I think that does give us some extra opportunity. All right, so let's go back. We're going to view all of these, and we want to view them in candle glance. There we go. Let's see what other ones look interesting. Helix energy, that looks kind of interesting here. The chart pattern that caught my eye is actually executed already. And let's make this green and somewhat fat. All right, so I'm looking at solid that line up here. This looks like an executed ascending triangle, and love it. Got the breakout, and look at where this area of new support lines up right here on that high. And again, we had the big giant breakout here, and then it has come and pulled way back, but it did execute this chart formation. I would say the caution I would give you is that this formation, the back end is what our measurement is. So if you add the height of the pattern to the breakout point, that's what you should expect as far as your minimum upside target. And just by eyeballing this, I can see that we just in one day pretty much fulfilled that chart pattern, but we've gotten the pullback and we're still holding above that area of support. The PMO is still rising. The scooter has moved into that hot zone, and look at the rising trend on the OBV. I think this one is, again, another great candidate. It had the big pop, went way up and has pulled way back, and now that offers us a great opportunity. So again, obviously when we're doing our scans, we're trying to find the best investment candidates, and so that's what I'm going through here to do after running those technical scans. All right, so let's continue through. What else looks interesting? Okay, I see a bit of a breakout here. But the PMO is starting to, you can see it curving back down. But I'm going to give IWF another look. This is an ETF. Be interesting to see. All right, so remember I was noting on the the thumbnail, the candle glance chart, the PMO looked like it was turning over, and it has started to decelerate, but it has not turned down just yet. And let's go ahead and look at the support resistance areas here. I think they're very interesting. Okay, first of all, that was previous resistance, had the breakout, pulled back just below it, continuing higher. And now I would say in the very short term, of course, and I'm going to make this skinny so you can see, we had at this all-time high, I believe it's an all-time high, I'll have to go double check that, we got that breakout, and you can see it in the thumbnail above. So again, I like to see those breakouts, and then what happened? It's pulled back to the breakout point, actually below it. And again, these are the kind of chart patterns, these are the sort of things you want to look at. I know a lot of times we pull up the charts for the 10 and 10, and or just any of them, upgrades, downgrades, and we're looking at them and they're making a breakout, and or they made it yesterday and they're continuing higher. You know, that is, you know, you want to find, and we always say it, don't we, Tom? Hey, wait for the pullback. We're hoping for the pullback. This would be interesting, but it would be good to see a pullback. So in all of the cases here, in some of these, we're getting that pullback already off of the breakout and then the pullback down. So, and given that you have very positive indicators, I think this is another way to, again, weed it out, weed down, and find something that is very interesting. Let's see. Somebody did ask, I'm looking 52-week highs. How long does that go back? How recent today, last 5 trading days? I will look at the scan. If we go back to the scan, this is, nope, let's find, here we go. All right, I'm just going to go and find that scan again. But the best way to do it is just to look at what the scanning language is. So I'll look at that for you and see what we can find out. And I want to edit the scan. So again, this is how you get there. All right. So it's maxed out 253 days, 20 daily volume, 20-day average of the daily volume greater than 40,000. So here you can see what we're looking at in terms of, we're looking at the last intraday update as well. So that's how we get to the stock symbols for that particular scan. All right, so let's go back to where we were. And I want to go back to our candle glance. All righty. CLF, somebody said they wanted to have a look at this one. I passed on it just because we've already had that big giant move to the upside. We always talk about chasing. I think you're right. We are starting to see that pullback. It is down 1 2/3% really today, right at this moment. So we are getting a pullback. It's just, it's really, it's made such a run. I think that this might be a good buying opportunity because, like I was just saying, we're looking for those pullbacks. But for me, I still feel like I'd be chasing this somewhat. So for me, Cliffs, I think it's a great one. And I believe when I think it had an upgrade, or we talked about it yesterday, and I had said that it looked tasty. The only reason I remember it was because I was hungry and it was Cliff Bars that I was thinking of. So I know we talked about this earlier. All right, what about a divergence on the PMO with IWF? Oh, I'll go back there. Let's look at that again. Okay. I see what we're talking about. Let's go ahead and I'll annotate it, and then we can close this out. That's what you're thinking of. But notice in the thumbnail, we don't have a top yet. So it's not really a negative divergence, in my opinion, at least when we're talking about PMO tops and price tops. So certainly something to watch for, because if we do get a PMO top here, now we're talking negative divergence in my mind. So, you know, we don't have a divergence at this point with what the PMO is doing, as you can see here in that thumbnail, because it is going along with the price move. We're seeing that deceleration, but it hasn't actually topped yet. So it's not an official negative divergence is what I would say. So hopefully that that did answer your question for that. All right. Well, I think that really concludes our scanning workshop. Here is our summary slide for you to see and enjoy. I remember that I did start with the predefined scans. And from there, I moved to the new 52-week highs. And then from there, we went into a candle glance and continued to modify those scans to narrow down, to narrow down, to narrow down, to get to some interesting trading opportunities. And those were the stock symbols that I did look at. That concludes a great show. We're at the end, Tom. It's been great. I do have to say, we didn't talk about weather at the beginning. I'm just going to bring it up because today our high is going to be 107 and tomorrow it's supposed to be 109. So we're being revisited by the devil, I would say, getting a little too close to Southern California, making it a little too hot. So I don't know what your weather is going to be like into the afternoon and evening, but wow, I'm going to be running that air.
Yeah, I think the whole East Coast really is just looking for rain and some storms and little mixed sunshine, but storms popping up in the afternoons. I think that's kind of like the extended forecast. That's typical.
Yeah.
I'm here on the East Coast, humid, hot, chance of storms. It's like the normal forecast. I could be a meteorologist here.
Absolutely. Well, it's usually pretty easy to be a meteorologist in California because our weather is generally so stagnant, like Hawaii. Boy, that would be a great place.
Yep. And, speaking of looking at the market, though, looking ahead, because we've talked a lot about earnings and, some of these companies getting pretty big reactions. We got some big ones coming up today after the bell. And I know John Hopkins and I talked about Texas Instruments. They come up today after the bell. That one, it started to outperform the semiconductors, the group. So I don't know if that's maybe a precursor to a strong report this afternoon or not. Semiconductors have kind of lagged a little bit, especially behind software and internet stocks. So that'll be a big one. And then tomorrow we've got Facebook, Boeing, and two others maybe that might not make everyone else's radar list, but going to be making mine. PayPal, which has been a very strong financial administration stock, along with Qualcomm. Qualcomm tends to do extremely well historically, seasonally, in the second half of the year versus the first half of the year. And Qualcomm just recently has been strengthening. Stocks up about 10% in the last month. So I think Qualcomm will be interesting. And then tomorrow we got Amazon, Intel, and Amgen.
Yep, absolutely. Just FYI, we'll post those modified scans in today's Market Watchers Live recap. So you'll want to keep an eye out for that.
Absolutely. So here it is, Tuesday. I mean, we have got hundreds and hundreds of companies.
Yes.
The rest of this week and into next week. Of course, Apple next week. It's just going to be an earnings parade. So that is what's going to be the driver behind the market, no doubt.
Yeah, and it'll be a driver behind our show, I think, for a while. We're going to have all those interesting ones to talk about.
Absolutely. Want to thank everybody for joining us today. Please remember to complete the survey as you exit. We'd love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we'll see you back here on Wednesday. Happy trading.